In Investing 101 today, Sam McElroy of At Financial joins me now to take a look at some places to invest money. Welcome back to the show.
Thanks for having me, Angela.
We have an interesting time. The stock market has been heading higher and has become very resilient. So what should investors be doing?
I think it's really interesting and a really timely question. You know, one of the things that we always try to tell people is that there really isn't a such thing as a good or a bad investment, although, you know, obviously there are some dogs. But the bigger question is, are your investments aligned with the purpose for which you're investing? So too often we find people who are investing for growth, but they need income, or they're invested for income and they need growth. So the idea is that you really want to make sure that the type of investments that you're investing in are the ones that are best suited for, you know, what it is that you're trying to accomplish.
So how do you know?
All right. So first thing is, if you're looking at stock market appreciation, or if you're looking for growth, so in essence you're looking for the share value of what you're holding to appreciate so that you can sell it for a profit in the future date, the first thing that we want to all know is that that tends to be a longer term strategy. So somebody who's maybe in their 20s or 30s and they're really just trying to accumulate assets, that would be somebody who's really oriented more for growth. Once people are more in their 60s, you know, maybe 70s, maybe even 50s, and they're trying to orient themselves or get ready to start drawing income off of these assets, then that's an instance where maybe growth isn't best suited for you, and you might be in a situation where it's time to start looking at what your income distribution model is going to look like.
What are some examples of growth stocks or sectors?
Yeah, so a growth stock is essentially a company that's going to take all their corporate earnings and reinvest it back in themselves to try to make themselves more valuable. So think about Facebook or Google or Apple or Tesla or somebody like that. You know, as compared to, say, a value stock, which is somebody who's going to try to attract investors by taking their corporate profits and being able to pay out a dividend or interest payment. And even outside of just talking about stocks, if you're really looking at income-oriented investments, then you might be talking about things like corporate bonds or preferred stock or REITs or other things like that as well, where they're more oriented for the dividend or interest that they're paying out as opposed to the share value appreciating.
What do you think about, I get this question from time to time, investing in hedge funds? What do you think about that?
I think it can be a good strategy. You know, the thing that's really important about understanding about investing in hedge funds is that it's not for everybody. You know, I think too often we see an article in the Wall Street Journal and we think it's a great strategy and that it's universally applicable. Hedge funds can be a place where you can get some better growth, some better performance, but it also has a lot more risk invested in it. So if you're in a situation where you're risk adverse, either because you don't have the time for it to recover, or you know, you just don't have the appetite or the stomach for the volatility, then you may not want to consider hedge funds. But if you're another person who's looking at maybe trying to find something that's interesting for 10% or 15% of what they have, and you can afford to do so, then hedge funds can be a place where you can get something that's not the standard kind of cookie cutter everyday portfolio.
Well, Sam, thank you for being here.
Yeah, thank you, Angela, anytime.